Passive investing has surged over the past few decades. Lots of investors have put money into ETFs that simply track the overall market. Lots of people, of course, have these investments that just automatically go into the market. And history shows that typically active managers have trouble keeping up with the broad market. Our guest, though, says that the high volume of passive investment changes the way markets behave and create a systemic risk that we're all exposed to. Let's get more from Michael Green, Chief Investment Strategist at Simplify Asset Management. Michael, it's great to see you. Thanks very much for joining us.
It's always a pleasure. Thank you for having me.
Now, we have heard about this for years, haven't we? That passive money goes into big stocks and that tends to push them up. And of course, they become market leaders and people think, oh, I'm just going to index as well. Do you think that the risk is getting worse?
I think the risk is absolutely getting worse. Unfortunately, the entire theory behind passive investing is predicated on the idea that you never actually enter markets or exit markets. You only hold securities, almost reminiscent to the Bitcoin type hodling framework. The challenge is when the minute you break that model and you recognize that these funds are receiving extraordinary inflows, the distortive impact of having an investor who is really just a systematic algorithm. Did you give me cash? If so, then buy. What should I buy? Everything in the index in proportion to its market capitalization. That ends up pushing the securities that are the largest and most volatile components of the index up disproportionately. That in turn means the next dollar in, which comes the very next day, or in the case of ETFs, sometimes the next minute, will actually push them even further in that same direction. It creates a momentum bias and it creates a size capitalization bias that we have seen play out in US markets for the past decade, and increasingly we're beginning to see around the globe.
Of course, Burton Malkiel's book, The Random Walk Down Wall Street, a Bible for many investors. And it does cite evidence that you're better off just in the index rather than trying to pick a skilled stock picker.
Well, this is, of course, one of the challenges, right? The theoretical framing of a random walk down Wall Street and the understanding of it. When Burton Malkiel wrote that paper, he actually identified that most individuals underperform due to the management fees associated with active management. We have seen those fees collapse. They're down about 80% from the time when Malkiel wrote that. The emphasis on reduced transactions, et cetera, was really critical in that era. And candidly, investors have benefited from the reduction of fees that passive investment has pushed through the industry. That is independent of the empirical reality, though, that market capitalization does not scale, or more accurately, liquidity does not scale with market capitalization. And so the bias that has been created in the market as we have grown passive from a very small fraction of the market in the early 1990s to today exceeding 50% by market capitalization in the US is driving valuations higher and causing stocks to behave in a more correlated fashion than we have ever seen before. Valuations being pushed to these levels lowers forward returns, but unfortunately, those forward returns fail to materialize as negative, as we've heard from many forecasters for the past decade, because the continued flow of passive elevates them even further. This has created a remarkable disconnect between the economic underpinnings and the actual performance of the securities that creates a systemic risk, one that can't really easily be diversified or hedged.
I mean, I can see it's a completely alien philosophy, isn't it? You buy stocks simply because they're a big part of the index. You almost don't care what the revenue and profits are.
You don't. You really, truly don't. And this actually helps to explain why markets have in many ways behaved like that famous episode of Seinfeld, the Costanza market. A rational, thoughtful investor will see price rise in the absence of a fundamental improvement. They will forecast forward. That means lower expected returns and reduce their emphasis on that security. A passive investment philosophy instead reinforces the momentum, simply assuming that everybody else has done the work, and that's why the price is rising. There is no consideration of a self-referential component to it. Unfortunately, we have very clear evidence that this is actually what is happening in markets, and it's creating many of the social ills that we experience as governments have biased investment for retirement purposes into passive vehicles particularly those that are focused on large cap stocks. This is why we have struggles with IPOs. A passive benchmark cannot buy an IPO in advance. It cannot deviate from itself to participate in that IPO. Private equity is experiencing extraordinary inability to take companies public, even though valuations are at all-time highs. Why? Because unfortunately, again, the passive index cannot deviate from the benchmark. This is creating many of the challenges that we're experiencing today, and unfortunately, it's leading both investors and policymakers astray.
I hadn't thought of that angle. I mean, we in Toronto are seeing just a denuding of our benchmark index because so many companies are being taken private. And I know in the States as well, there's been a significant drop in public companies.
It's been a combination of mergers, which for public companies are actually beneficial by increasing the scale of the company, raising its market capitalization relative to the overall universe through a stock merger. That ultimately improves its positioning within the index and contributes to forward outperformance. That's why we've seen the mergers happen in many cases. There also has been a failure to enforce antitrust, which is a related but separate issue. In terms of new IPOs, they just don't exist. We have run well below historical levels. It's not that new companies aren't being created or that there's not new interesting companies being created. It's just the ability to successfully take a company public is increasingly challenged.
I mean, I don't know if I can call it the doomsday scenario. Critics of passive investing have warned for years about a possible self-reinforcing cascade. The big stocks start underperforming, investors dump their index funds, and then the big stocks are sold in increasing amounts. But that has yet to come about.
Yeah, it absolutely is yet to come about. Our research suggests that somewhere in the 70 to 80% passive share range, we enter a self-critical regime in which it becomes volatility reinforced that ultimately that crash occurs. I don't think investors are going to change their behaviors for the very simple reason that, one, there's a liability protected style of investing for 401ks and IRAs where advisors are incentivized by our legal frameworks to push people into passive investments, regardless of their valuations. The second factor is, of course, the performance is enhanced by passive investing. My current work suggests that up to 15% a year of the gains of the S&P 500 can now be attributed to the growth of passive investing in the markets. That's really all the returns that we're getting at this point. But as passive share grows, that could actually accelerate before that volatility event occurs.
Michael, we'll have to leave it there. Always great hearing from you, and thanks.
Thank you for having me.
Michael Green, Chief Investment Strategist at Simplify Asset Management.